If you own any covered call ETFs, I'm going to show you why you are throwing away money down the drain. Even if you want cash flow, it makes more sense to own the underlying asset than owning these covered call ETFs. And I'm going to prove it to you in this video. So stop being silly and throwing away your money with all these ETFs, the QYLDs, the Teslys, the whatevers. But as usual, none of this is financial advice. I am not a financial advisor.
Knowledge.
So in this video, let's look at a couple different examples. And we're going to start with the OG of covered call ETFs, QYLD. This guy's been running for a long time, since back in late 2013. But even with QYLD, you can see the continual decline of this asset, and it's been down 28% at the time of this recording. Now, QYLD does give you about a 10% yield most years, but it has the continual decline of the asset price. So what's the main question we want to ask in this video? If we want cash flow, would it make more sense to do something like QYLD, the Global X Nasdaq 100 covered call ETF, and then capture this 10% yield, but also have the continual decline of the asset price over the past decade, really, for this thing? Or would it make more sense to drop these funds, your initial investment, into the underlying asset instead? So in this case, it'd be the Nasdaq 100. We can use something like QQQ and then withdraw a monthly amount instead. So let's compare these two results on Portfolio Visualizer. And let's do a semi-realistic scenario if you wanted to retire something like QYLD. Let's say you're looking for a lavish retirement and you want $100,000 per year in dividends to live comfortably for you and your family. In order to get $100,000 in dividends with a 10% yield from QYLD, that means you need $1 million. Not complicated. So let's put our initial amount as $1 million. And then with this, we're not going to reinvest any of the dividends because we are taking out this money. We're actually spending the dividend. So let's put in QYLD and we have 100%. If we didn't reinvest anything, we started with $1 million. Now we are down to $699,000. We have a 30% decrease and worst max drawdown of almost 40%. But hey, we've been living on dividends for the past decade using QYLD. Yes, you got a lot of dividends, but you also lost over $300,000 since you put in your money a decade ago. But what if we did something else? What if instead of using QYLD, we just bought QQQ instead? This is a Nasdaq 100 covered call ETF. What if we just use the Nasdaq instead and then withdrew that amount 10% per year? So let's figure out what 10% per year is. If we did a monthly amount, 10 divided by 12 is 0.83333333. So we know every month we have to withdraw 0.833333 of our portfolio, and this will be 10% yearly. So let's compare this instead on here. And QYLD started in late 2013. So let's just do 2014, and we're going to do QQQ instead. And we are going to have our dividends, and we're going to withdraw a fixed percentage per month. And that's that 0.83333333. And let's see these results. So if instead of buying QYLD and we just use QQQ, withdraw 10% annually, which is this amount, look at our portfolio, guys. We would have started with $1 million and we would have ended up with $1,961,000. We would have almost had $2 million, but we've also would have withdrew a decent amount. We would have withdrew 10% per year, allowing us to live off QQQ and have a price appreciation. So these are two very different stories. With our QQQ portfolio, the Nasdaq 100, we can easily live on this amount and allow it to grow. If we look at our QYLD portfolio, it sinks over time, losing you value, and you get a 10% dividend. But why not pay myself 10% per year and then allow my asset price to grow? And then I can get more per year instead of just watching my initial investment dwindle away like in QYLD. And if we put these on the same chart, guys, we're going to see the same thing. What would have happened? QQQ would have went up, even with the same withdrawn amount. QYLD would be sinking down low, losing us value every year. Why would we choose an asset that's going to depreciate our portfolio, give us worse returns, when we can get the same performance just withdrawing from the underlying asset? So in all reality, investing in QYLD doesn't make any sense if it's going to track the Nasdaq 100, give you the same downside risk, and then not give you the same upside when you could just withdraw from QQQ instead. This is a huge difference. And this reflects in the best years, right? 54% for QQQ, 22% for QYLD. Now the worst year is a lot different for QYLD, but that's also because you're withdrawing and then the dividends cover that. But your upside is much greater on QQQ. And let's do something crazy. Let's say we wanted 1% per month using QQQ. What would happen then? What would our results be? Oh, look, our portfolio still would have grew. Yes, we have the 2022 right here, but it still would have grew over the past decade, and we would still be way up withdrawing 1% per year. This would be a consistent 12% per year we could withdraw, and it would be a lot better than QYLD. So I've shown you with QQQ and QYLD, it doesn't make any sense to do QYLD. What about something like Tesly versus Tesla? Will these results be the same? And I'm going to be ridiculous in this scenario because Tesly believers are ridiculous. If I still had $1 million and I believed in their 50% yield all year round without the dramatic price appreciation, let's see what would have happened. I believed I could maintain this portfolio with a 50% dividend. What would have fared better since 2023, since Tesly came out? Buying Tesly and not reinvesting the dividends and living off of those and utilizing that as cash, or just buying Tesla and withdrawing a fixed percentage, about the same amount as the Tesly dividend. So let's look at Tesly and let's not reinvest the dividends just to see where we would end up right now at the time of this recording on 3/5. If we start with $1 million, we'd be at $643,000 right now. That's over $350,000 gone because of Tesly going down and then all the dividends. And we are assuming we're not reinvesting these dividends. We're just taking them and then actually using them to live off of. So you would have a large drawdown. But hey, you got some awesome yield that didn't cover your portfolio with drawdown, but you know, okay, you got a dividend, cool on you. So let's compare this instead. What happens if I bought Tesla with $1 million in early 2023 with $1 million and then I withdrew a crazy amount? What happens if I withdraw 5% per month? That'd be 60% per year, beating the Tesla dividend if I just invested in Tesla at $1 million in early 2023. So I have Tesla, I had $1 million, and I'm withdrawing 5% per month. So of course it's going to go down. But what's our current balance right now? Almost $800,000. Compared to what? With Tesla, $643,000. I have an extra $150,000 if I withdrew 5% per month using Tesla instead of Tesla. This is way different. $150,000 plus I'm getting 5% per month. That's 60% yield per year compared to the current distribution rate, which is 55%. So if I just bought Tesla instead of Tesly, I'd have a larger balance in my portfolio and I would have had a bigger dividend. So what does that mean about Tesly? It's garbage, like I said in all my other videos, and I don't know why anyone is buying these thinking they can recoup their money with a stupid dividend when you would do better just buying Tesla and then selling 5% each month instead. You would still go down. 5% is really aggressive, but you could do it. And if you really want to, it doesn't financially make sense in my mind, but if this is how you want to live your life, go ahead. So what can we learn in our QYLD example and our Tesly example? There's a higher chance of the underlying asset will outperform the covered call ETF. With the covered call ETF, you are limiting your upside without limiting the downside. It can still crash. You experience the same depreciation of the stock price during a crash without the same appreciation. Most of these covered call ETFs are garbage. And I do say most because there is one that might have some merit, and that is currently JEPI. That is the JP Morgan Equity Premium Income ETF. So let's compare these and then you can see what I'm talking about. So let's put JEPI as portfolio 1. Let's put QYLD, the OG daddy, on here. Then let's just also put SPY, the underlying index. And currently JEPI is paying about a 8% dividend on a monthly. So let's figure out what that is on a month-to-month basis. And that's 0.66666666. Okay, so if we had $1 million and we're just going to go to these funds inception, and if we wanted to withdraw 0.666666, that's about 8% per year. Let's see how JEPI would do versus QYLD versus just owning something like SPY and then withdrawing the same fixed amount. And when we scroll down, we can see QYLD, the red, completely sinks down after the start since 2020. It doesn't recover after 2022, and then it lags behind. But we can see something interesting. We have JEPI, which is the blue portfolio, does outperform during the bear market when you're withdrawing 0.66 per month or 8% per year. So you can see there are times when JEPI does outperform SPY, the S&P 500, on a withdrawing basis. If this is something you wanted to live off of, JEPI does outperform during certain periods. We can't really say that about QYLD. It's not even close to SPY or JEPI. You can see SPY caught back up. That's portfolio 3, the yellow. It surpassed it again. but you did have a decent amount of performance for JEPI. So that'd be from April to about July. So about a year where JEPI had a better portfolio value than SPY when we were withdrawing 0.6666 per month, and that's about 8% per year. So I can see JEPI having some validity, but QYLD, Tesly, the other ones, they don't have any validity in my mind because there hasn't been any periods where they'd be better owning those covered call ETFs versus the underlying asset. So it is possible JEPI might be a good bear market play to stabilize your portfolio from large drawdown. So what's the lesson of this video? Covered call ETFs are goofy overall. They're goofy. Most times it makes more sense to buy the underlying asset and withdraw a fixed percentage instead of capping the upside and then taking out money with the same downside risk. Argue with me in the comments if you want, but you're wrong. The back tests spoke for themselves. When you can rewatch it in the video, you can do this for yourself and see. Now, I would have liked to compare things like NVIDIA, especially as NVIDIA is on a rip. I would have liked to compare things with Coney, the Yield Max coin option premium. But for some reason on Portfolio Visualizer, it doesn't really give me much data over the past year. You can see it's been out since August 2023, but on Portfolio Visualizer, all I get is since December 2023. So it's only 3 months of data. So I'm not going to compare things like Coney and NVIDIA, but hopefully in the future we can do that and see if it'd be better just to own Coin or NVIDIA compared to these ETFs. But overall, I think my point is proven in this video. It's probably better to own the underlying asset instead of these covered call ETFs. So are covered call ETFs your path to easy retirement? Definitely not, but I can show you how to do that easily right here. Peace.